Well, 2014 has been a year of dreams. On all counts, Indian markets have got re-rated. The big question mark is that in the medium term, in the short term, is this as good as it gets, or 2015 will be even a bigger and a grander year for Indian stock markets? To understand the market setup, to talk about valuations, themes and some ideas, I have a very special guest, a market veteran, someone who needs no introduction whatsoever. Anup Maheshwari, Head of Equities and Corporate Strategy with DSP BlackRock.
Thanks, Nikunj.
Great to have you back. Thank you for joining us. 2014 has been a dream year. But my question to you is that where do we go from here? Nifty this year is up already 35%.
Sure. So, Nikunj, this typically tends to happen in cycles where earnings are beginning to transition. Clearly, there have been a lot of factors this year that have worked in our favor, starting last year, actually, from the lows where India's balance sheet started undergoing repair after the lows of September, then the government change. Now we've got something like oil prices helping us. So our stars have been pretty good. We seem to have also reached the point of a trough of an economic cycle, so we're picking up on that front already, which is good for corporate earnings, and therefore, a lot of this starts getting priced into markets very quickly. All we'd say, frankly, right now, the message we're sending out to investors is that, depending on levels of markets, your time horizon of how you judge markets should keep changing. So if you're buying markets north of 20p, then you better have an 8 to 10 year view on markets. I think at this point, having a 5-year view is good to judge yourself in terms of the returns that you're likely to make and from the asset class. And we're still holding the view right now with current valuations. It still looks like a market that can deliver a 15% sort of annualized return expectation over a 5-year period. As we know, markets are never linear. So we don't know if it's front-ended, back-ended, or how it progresses. But I think that's a very reasonable expectation to work with, which is better than most other asset classes available. So we're still quite positive. We still think it's a very under-owned asset. People don't have too much of a choice domestically, and more money is likely to come in.
Anup, there were two major triggers for 2015 for Indian markets. One, a stable government, and B, a virtual collapse in commodity cycle. For 2015, those triggers will not be there. So what will take these markets higher?
I think interest rate reductions are obviously a big aspect now for valuations going forward. I think India is one of the only markets in the world where interest rates today are higher than what they were during the Lehman crisis. The world over, people are grappling with the other extreme end of interest rates. So we have yet to see that get fully factored into valuations. As you know, when interest rates go down, it's very positive for equity valuations and for price that you put to earnings. So our sense is that benefit is still to play out through next year. We think interest rate reductions can be much sharper than what people are anticipating, just given the way inflation is trending at the moment. So I think that will be a very important aspect. And then most importantly will be earnings growth. We've gone through 4-5 years of very poor earnings growth. FY16 will be very, very important in terms of whether we will deliver superior earnings growth that people are looking forward to or not. Our guess today is with such a big reduction in oil prices, 45% from the peak, there has to be some net positive benefit coming into the system in terms of consumption, margins, etc. So hopefully that will reflect in FY16. So earnings and interest rates, I think, are the two key drivers for valuations from here.
Okay, let's talk about your current portfolio strategy. I was scanning through your portfolio, and the heart of your portfolio is the private banking space. You've taken a big bet there. Some would argue that the private banking space is already a crowded space. Aren't you too late in the trade?
Well, we've been holding this for a while, and it's a very large part of the index as well, as you know. So it's not a new position for us or the market. It continues to be one of the areas which is best levered to the whole economic cycle. We have very good managements, and valuations across even the private sector banks, frankly, are still not way above average, or in some cases not even close to the peak that they've been earlier. So our sense is there is still a lot of consistent growth as well as valuation upside for some of the private sector banks, which are very well managed. And for banking in general, I think, it has to be one of the key sectors that will perform through this cycle. Because, we've seen, banks take the brunt of it, particularly public sector banks as well so far. But we're very enthused by all the changes taking place, and through a lower interest rate cycle and a pickup in the economy, banks tend to clearly benefit.
The fact that State Bank of India has a big holding in some of your key portfolios, Is that an indication that you're not worried about asset quality?
Yeah, incrementally the worry is reducing. I think by the end of this year, we'll probably hopefully cross that hurdle where incrementally we have to keep worrying about further asset deterioration. I think things are happening to get a lot of assets back on track in terms of generating cash flows, at least to service the banks. We're not so sure about whether shareholders will make much out of it, but definitely the banks will get serviced eventually. And I think the RBI is also taking cognizance of this and is planning some further easing of restructuring related norms. So all put together, I think incremental asset quality is becoming less and less of a concern. I think over time the concern will shift more to growth, because growth is still a challenge. There's very modest credit growth in the system. Equity capital is the challenge. So those are the things that I think the market will tend to focus on more over the coming year to see how banks address these issues. But what we really like is what the RBI is doing in terms of changing governance in public sector bank and structures at the top. I think that is very secular, and that is something we have to watch very closely.
So is it time to go down the ladder in the PSU banking space? Most of the fund managers, they've avoided PSU banks in the past. If they've bought PSU banks in the past, they've only bought the three names, SBI, BOB, and to a large extent PNB. Is it time to go down the ladder now?
I think everybody is willing to take a certain risk view at a certain point in time. I think until you wait for certain hurdles to be met, because again, all that I've mentioned are issues that have yet to fully come through. So as and when your comfort level develops, I'm sure people will probably look at a wider scope of banks as well. But for now, I think we're much more comfortable, obviously, with the larger banks, as well as where we have managements already in place. Wherever the managements are there, it's easier to take a call than to anticipate new top-level managements in banks.
Every fund manager would say, I like to stick to quality. There are enough quality stocks in Indian stock markets, but unfortunately, quality stocks are coming at a ridiculous price.
Yeah.
So what happens next?
So, we're also a little concerned that we don't walk into some sort of a quality bubble.
Is there a quality bubble somewhere?
Well, you've got to say companies are continuing to grow. I think earnings growth is underpinning a lot of these stock price performances. But now you have a combination of fairly high P valuations hinging on earnings growth. So the sensitivity to that growth is very, very extreme. Any slight growth reduction or adjustment can lead to higher than expected price corrections. So I think you have to be very careful. It's very stock specific, but when you're paying 40p, there's not much room for error. So our sense is, there are, you may see some corrections in these names, mainly time corrections normally, because a lot of these are good secular businesses. But you have to be cognizant of the price you're paying for any cash flow. And there are always alternatives in the marketplace. So, we have to sort of balance it. I can't give you a perfect answer, but the fact is there are definitely pockets of overvaluation already.
So incrementally, you will not allocate money into staples or some of these consumer names?
We're underweight staples as of now. I mean, great long-term sector, but it's already performed. When inflation is on its way down, we observe that these sectors tend to underperform a little bit. Their pricing power advantage tends to reduce.
Shouldn't it be the other way around? If inflation comes down, consumer will spend more?
Yeah, so that's the conventional thought. But what tends to happen in staples, what we've seen, is they actually tend to do a little better when both the economy is doing well and prices are heading up, even though raw material prices may be heading up. Traditionally, they've actually performed well through those scenarios. And they've underperformed when raw material prices are going down if you have some degree of correction at a consumption level. So what we're observing is that the rural side of India is definitely slowing down. I think that's very evident already in tractor demand. But even consumption is slowing down from rural India. And a lot of the consumer staple markets still derive a fair amount of their growth from rural India as well. So that's an area also of concern. And just given the high valuations, I think there's a time correction that's underway.
For someone who's bought into Matrix and Ranbaxy a couple of years ago, if I look at your latest portfolio, hardly any pharma names. Pharma companies are growing and some of them are not terribly expensive as well. Any specific reason why you've given pharma a skip?
Well, it's not a total skip. And, I must qualify this by saying we've always had a soft spot for the pharma sector in our portfolios, in the sense that it's one of the best performing or shareholder value creating sectors in the long term. There's no question about it. We're underweight at this point in time for the simple reason that we see valuations again a little stretched, more than we'd like it to be. And there have been a lot of these regulatory issues that are creating a little bit of uncertainty on earning streams. So it's something that we felt we'd just be a little cautious on for the time being. It's not a sector that we're likely to stay underweight on structurally. We're itching to own it more. But I'd say for now we're sitting a little underweight just given some of these concerns.
So Anup, if I could just divide the market into two pockets or two buckets. Bucket number one, which is expensive, IT, pharma, consumer names, but they're still growing. You can predict next 3 quarters, next 4 quarters. Then you've got industrials and cyclicals, which are cheap, but they are not growing. So which is a better bucket to buy?
So right now, if you look at our portfolios, we're more tilted towards some of the value-oriented parts of the market.
Does it make sense to buy because earnings have not picked up? It's still a hope trade.
That's what you're anticipating. Okay. So it's a bit of a view on the fact that after 4 or 5 years of the economy slowing down, we're reaching a trough. We'll see a pickup. It's a slow pickup. It's not a very sharp pickup, clearly. But, as interest rates go down, there tends to be a positive effect on a lot of balance sheets that are more cyclical in nature. And as the economy picks up, hopefully we'll see some positive effect there. And generally, valuations are still reasonably low in many cases. So it's really that combination that we're looking for. It's a very top-down thing that I'm saying to you, but a lot depends on the sort of stocks that you buy. And but at an overall portfolio context, just given valuations, given risk reward, we're a little more tilted towards the value side of the market.
What explains the underlying momentum in autos? I know auto sales have revived, but auto stocks have just gone crazy.
Well, across the board, there are different catalysts for different parts of autos. So in passenger vehicles, we're seeing, the largest players doing really well. And that seems fairly structured at the moment, so which is why you're seeing some good valuations there. In the medium heavy commercial vehicle segment, there is a hope that there will be a pickup at some stage. We're already seeing very early signs of it. Again, it's a slow cycle by the looks of it, but nonetheless, that's an interesting area to look at, and the delta there can be fairly significant. Two-wheelers is generally good, scooters particularly. I mean, there's a big transition within that market and scooter demand is growing very well. And auto ancillaries as well, I think remains a very good structural play, benefiting both from domestic as well as export markets, and you have a few very good players now that have emerged. So across the spectrum, there's some good opportunities available, I guess, and that's why we're still overweight on autos and consumer discretionary in general.
And are you likely to remain overweight there? Because if interest rates come down, the immediate spending power, at least for autos, will increase.
Yeah, it benefits, and I think urban demand is something we're counting on as well. As I said, the rural side will probably see a bit of a slowdown whether interest rates fall or not, but the urban side should hopefully compensate for that.
Let's talk about the global setup, and we may feel happy, we may feel excited that Indian markets are standing out, we are standing tall when it comes to the global environment, but ultimately all major markets currently are sitting at a record high. Do you think on incremental basis we also have to take cognizant of global challenges?
Oh yeah, of course. A lot of the volatility we've experienced in the last 4 or 5 years has been largely on that front. And the fact is, there is a lot of global effect in terms of flows into our market. So we have to be aware of what's happening globally as well. To be honest, a lot of these things are hindsight analysis. It's very difficult to anticipate some of these. But all we'd say is an environment where there's still liquidity, it's bound to be positive for emerging markets and for India in particular. But you have to be cognizant of any big shifts globally that tend to occur or flow changes, because they can be disruptive in the short run. But as I said, again, they're disruptive in the short run. I think longer run, we're seeing already markets not being as correlated as they were in the past. It's becoming more bottom-up globally as well, not just within India. And to that extent, I think we're still hopeful. We're always biased towards India, as you know, and therefore we're still quite positive on India relative to other places.
2 years ago, India was the tallest of. Now we are standing tall. Do we have potential to be an outlier now?
Yeah, as I said, we have the potential to outperform. But, somewhere down the road, we're all tied to some common chord of liquidity. And therefore, in the short run, there are effects. If global markets do go through a compression, it'll have some dampening effect on the Indian market as well. So we're not entirely uncorrelated. But I think as you go over longer time frames, those correlations tend to break down more significantly.
Okay. The other big trend is a virtual demise in crude, crash in some commodity prices. How should one read into the crack in crude, and how will India benefit?
So it's very good for India up to a point. Beyond a point, I think what tends to happen is as commodity prices decline further, then it actually creates negative effects in terms of deflationary fears and concerns on growth. And that could potentially hurt India as well in terms of at least the export side. So it's very good for us so far. It will have positive effects on consumption somewhere down the line. It's great for companies because while they're still struggling for sales growth, at least there is a margin lever that has come in. So margin should start improving. So the initial phase, I've got to say, is very positive. And we'll see how it progresses from here. At this point in time, I think, at least the oil producing countries seem to be quite happy to pump out more oil at lower prices to maintain their budgets. But if oil declines beyond a point, then we've got to see what actually that creates in terms of sentiment and expectations. So we'll see. As of now, we're treating it more as a positive.
You have exposure to ONGC, you have exposure to oil marketing stocks. At the current juncture, do you think oil marketing stocks are priced to perfection?
So a lot of them are still trading at book or a little above book. And they're going through a fairly strong transition in their balance sheet over the past few years. Liquidity has improved a lot in balance sheet terms. And hopefully their ROEs, return on equity, is what we tend to focus on these companies. And their ROEs, which were sort of single digit, will hopefully move back into early double digits. And that's really why there is so much of interest in the sector. What we have to be careful of is incremental capital allocation by public sector companies in general. Because as your cash flows start improving, you get back into project mode. And then we've got to see the incremental returns on those investments. So I'd say for now, when you're sort of looking at these stocks at around book value, there's still a margin of safety. Beyond a certain point, all these other challenges start coming up and you have to be more cognizant.
Anup, what drives the market in the short term is sentiment. In the medium term, it is liquidity. Long term, it is always earnings. We've talked about earnings. Sentiment right now is favorable. But what about liquidity? Come 1st of Jan, a deluge of government paper will hit the market. Government has to raise 40,000 crore before 31st of March. That's going to just disturb the liquidity equilibrium.
I think we've got to not underestimate domestic liquidity. As you know, there's a lot of liquidity domestically that has been parked in physical assets over financial assets over the last 5 years. And what we're seeing is the sort of momentum. At the end of the day, everyone's sort of following a bit of a trend. And now that we're seeing real estate prices consolidating, correcting in some cases, gold going nowhere, I think this sort of balance sheet, household balance sheet mix between physical and financial assets will start correcting a little bit. So don't underestimate liquidity flow of domestic money coming back into equities.
But the paper which will come from government stable would be ONGC, Coal India, SAIL, GAIL. Will you actually get retail buyers for that?
No, not just for that. I'm saying into the market in aggregate.
Okay.
40,000 crores, $4-5 billion or $6 billion is not something that cannot be absorbed by this market when you're getting sort of strong foreign flows also of the magnitude of $20 billion or so a year. You have, of course, LIC as a large local insurance company also putting in about $10 billion every year. And then you have this domestic liquidity effect. So I think it will get absorbed. I don't see a challenge there. So I wouldn't think liquidity is a bit of an issue at the moment. And especially at a time where rates are heading lower, I think liquidity should be comfortable.
But is the average retail investor back? For the longest time, the average Indian retail investor has been absent.
So we are already seeing positive flows now for 4 or 5 months. You could debate whether it's more high net worth type flows dominated by them and less a little bit by retail. But I think retail investors will come. Sometimes, unfortunately, investors need to see the comfort of markets having performed before they come in. So I think we're going through that transition. But the way we see it is, it is a good asset class. It is underinvested at the moment. And as people see it performing, more people will tend to come in. I just hope that, it comes in at a reasonable valuation and not after the market's already moved too much. But, at this point in time, our sense is liquidity flow will be more positive than negative.
So for those who are investing now, when Sensex is at 29,000, Nifty at about 8,500, what should be the return expectation from next 3 to 5 years? Can they get double-digit compounded returns?
Yeah. So as I said, I think it's like this. When you're investing, let's say, north of 20p,
we're not there.
Which we're not there. Then you've got to have an 8 to 10 year horizon by the looks of it, to see that
cycle will play out.
15% annualized return. Normally when you're entering into equities, you're expecting around a 15% annualized return, because that's the underlying rate of corporate earnings growth through long cycles, right? So you can go through patches where it's below that and some patches where it's above that. But when you're entering at very high P, you have to have a 8 to 10 year horizon. When you're entering at a valuation that we are at today, which is above average but not dramatically high, then I think a 5-year horizon is reasonably good to judge whether the asset class has generated the returns you expected to or not. I think 12 months is not a period to judge it. If you're buying the market way below average valuations, you probably can have even a 2-year view and it might just play itself out very well.
That time is over now.
Yeah. So the point is, right now we're saying 5 years. And can the market deliver 15% annualized return over a 5-year period through a positive earnings cycle and lower interest rates? Yes. We think that is a reasonable expectation to have through this cycle.
That's a realistic expectation. But when bull markets, they start, they always compound at 30-40%. That's the history of the market.
Yeah, so as I said, markets are never linear. That's the problem. And that's what creates the indiscipline. That's what creates
the excitement also.
The excitement and, a lot of the hangover after the excitement as well. But, as I said, actually, if you sit right through it, it doesn't really matter. I'll just give you one small example if we have the time. We had launched a super SIP fund way back in November 2005. And I still remember that was like a 21-year plan. And
2005, that's
2005
about 9,
end,
years.
November.
Okay.
Yeah, so it's nearly 10 years now.
10 years.
And last year in August, September, when we were at the lows, I'd gone out for marketing and I still remember in Chennai, we had this audience and a distributor got up and said, what are you talking about long-term investing? We put money in your super SIP in 2005, we're in 2014, and the compounded annualized return is 6.5% or something like that. Move forward 1 year, and now the return is 16.5% annualized for that entire period, right? So, the point is the asset class delivers. It can severely test your patience, but it all is a function of the valuation that you're buying it through a period of time. But from 2005 to now, with 4 good years and 6 bad years, roughly, or 5 bad years, this product has delivered a 16.5% annualized return, which is not bad, and this is tax-free. Exactly. So the point is, it works. It's just that if you keep judging it immediately or in too short horizons, that's where we start making mistakes. If you get 40% of that in year 1, it just distorts your entire, thought process sometimes and your allocation. So just stick to the basics and you'll turn out okay.
Final question purely on market behavior. Every time I interact with some of our viewers, some retail investors, they are of the view, 30% बढ़ गया और कितना बढ़ेगा? Are we too late now?
No, I don't think we're late. As I said, if you just invest through the cycle, I think there's enough return. You've got to look at the market always in valuation terms, not at index level terms.
So the margin of safety is still in favor of a long-term investor?
Absolutely, no question about it.
No, really appreciate your time and glad you could join us.
Thank you. Thanks, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.